Welcome to the Deep Dive, where we take a stack of the latest insights, research, and our own analyses to give you the most important nuggets of knowledge. We're here to make you well-informed, quickly, and with just enough surprising facts to keep you hooked. Today, we're plunging into a truly remarkable economic story. Ghana's Cedi has staged an extraordinary recovery in 2025, appreciating by 42% against the US dollar since January, trading at approximately GHS 10.20 USD by late May. Now, this surge, it's a stark contrast to its 45.1% depreciation back in 2022, and it seems to be driven by a combination of, well, robust macroeconomic policies and some pretty favorable global conditions. And I'm John, alongside my brilliant colleague, Wendy.
Hi, everyone.
We're both staff at WeWire, and we're thrilled to bring you this week's Deep Dive. And this Deep Dive is drawing directly from the insights we've pulled together in our latest weekly Stay Wired recap. Our mission today is, well, to explain how the Cedi achieved this remarkable turnaround and, maybe more importantly, what it means for Ghana's dynamic fintech sector, for global investors, and maybe even for your own understanding of market resilience.
Yeah, and you might be surprised by some of the ripple effects we uncover that go far beyond just the currency numbers themselves.
Okay, so let's unpack this then. A 42% appreciation against the US dollar in just a few months. I mean, that's not just luck, right? It's got to be the result of some very specific strategic forces at play.
Oh, absolutely, not just luck.
This isn't merely a statistical blip. It feels like a profound economic shift that really demands a closer look at the underlying mechanisms. Where do we even begin to dissect such an extraordinary turnaround?
It's truly fascinating, John. And what stands out immediately is the multifaceted approach Ghana took, combined with some genuinely fortunate global conditions, like you mentioned. Our sources pinpoint four major pillars that underpin this surge, creating a powerful synergy, really, that propelled the Cedi's ascent from that really challenging depreciation in 2022 to this robust appreciation we're seeing now.
Four pillars, okay.
Yeah, these weren't isolated events, but rather a carefully orchestrated or perhaps, serendipitously aligned set of factors that converged to create this success story. So first, we absolutely have to talk about the gold windfall. Imagine hitting the jackpot not once, but 28 times in a row.
28.
Yeah, that's essentially what happened with gold prices. They hit an astonishing 28 record highs by April 2025. Now, just think about that for a moment. 28 record highs in just a few months. That's not just a good period for gold, it's, well, extraordinary, almost unprecedented.
Unbelievable.
And for Ghana, being a significant gold producer, this directly translated into a massive injection of foreign exchange. The numbers are truly staggering. Gold contributed a massive 60% of Ghana's export receipts in the first quarter of 2025.
60% just from gold.
And 60%. So this wasn't just a small boost to their reserves. It was like a torrential downpour of hard currency, significantly shoring up the Cedi's position against the dollar and other major currencies. This influx of foreign currency reduced the pressure on the Cedi, right? Because there was less demand for dollars to facilitate imports or service external debts. However, and here's a crucial insight, this windfall, while incredibly beneficial, also highlights a potential vulnerability. What if gold prices, decline sharply next year?
Right, that's the risk.
Has Ghana built enough structural resilience beyond this commodity boom, or is this recovery still heavily dependent on these external factors? It's that classic question of short-term gain versus long-term structural change.
That's a critical point. I mean, a massive influx of revenue is fantastic, but if it's tied too heavily to one commodity, it can absolutely be a double-edged sword down the line.
So beyond the commodity boom, what other deliberate steps did Ghana take? Okay, so that leads us directly to the second pillar, the crucial role of International Monetary Fund, IMF support. Ghana secured a $3 billion extended credit facility from the IMF. Now, while the financial assistance itself is, of course, vital for immediate liquidity, what an IMF program truly signifies is it's a profound vote of confidence from the global financial community.
Right, it's like a stamp of approval.
Exactly. It's a powerful signal to international markets that a country is committed to fiscal discipline, undergoing structural economic reforms, and is on a path toward greater stability and transparency. For investors, this significantly de-risks the environment. It tells them that Ghana is serious about managing its economy responsibly, which in turn helps unlock other forms of funding.
Like from other lenders or private investors.
Precisely. From bilateral loans to private sector investments. It ultimately reassures a broader spectrum of international investors that their capital will be safer and potentially yield better returns in Ghana. This stamp of approval is often the catalyst needed to shift market sentiment from skepticism to, let's say, cautious optimism. And beyond the direct cash, the IMF's involvement also carries this implicit expectation of sustained fiscal discipline.
So it keeps the pressure on, in a good way.
Kind of, yeah. It turns this vote of confidence into a continuous accountability mechanism that sort of externalizes Ghana's commitment to reform.
Okay, so it's not just the cash infusion, but the credibility and that implicit promise of ongoing reform that really matters. That's a powerful signal.
And speaking of strong signals, what about Ghana's own domestic policy moves? They must have done something internally, too.
Absolutely. The third pillar is Ghana's implementation of stringent monetary policies. Specifically, we're looking at a substantial 500 basis point rate hike, pushing the policy rate all the way up to 30%.
500 basis points.
Yeah.
That's a huge jump, right? Usually it's like 25 or 50. Exactly. Most central banks make adjustments in much smaller increments. Maybe 75 if they're being really aggressive. A 500 basis point hike is an exceptionally bold and decisive move. It shows an urgent commitment to macroeconomic stability. Its primary aim is, of course, to combat inflation by making borrowing more expensive, thereby cooling down economic activity and reducing those inflationary pressures across the board. But it also serves another critical purpose. By offering such high interest rates, the Cedi becomes incredibly attractive for holding,
Okay.
both for domestic savers and for international investors seeking those higher yields. This increases demand for the local currency, further bolstering its value against foreign currencies. It's a clear indication of the central bank's unwavering commitment to price stability, even if it means some, short-term economic tightening or maybe slower growth in certain sectors.
That's an aggressive move for sure. It makes the CD very appealing to hold. But you mentioned tightening. Are there any potential downsides or hidden risks to such an aggressive rate hike for Ghana's domestic economy, say for local businesses trying to borrow and grow?
That's a crucial question, John, and absolutely there are considerations. While the immediate goal of currency stabilization is met, such high interest rates can indeed make domestic borrowing very expensive for businesses and individuals.
Yeah, I can imagine.
It could potentially stifle investment, job creation, and overall economic expansion in the short to medium term. It's a trade-off, right? Strong currency stability now, but possibly at the cost of some immediate domestic growth. And this is where the other pillars, like the IMF's support and that gold revenue, become even more critical, helping to cushion some of those domestic impacts.
Okay, that makes sense. It's a balancing act. So what's the fourth pillar?
And finally, the fourth one, we have the Innovative Bank of Ghana's Gold Bond Initiative. Now, this isn't just another policy. It's a truly unique and strategic maneuver. This initiative mandates that 20% of all gold exports must be purchased in cedis.
Oh, interesting. How does that work?
Well, it's not just a minor administrative tweak. It's a direct, frankly, quite genius mechanism to significantly boost Ghana's foreign exchange reserves and, crucially, reduce its reliance on external currencies for its most significant export. By requiring a portion of gold earnings to be converted into cedis within Ghana, the central bank directly increases the demand for the local currency and simultaneously builds up its foreign currency reserves without having to actively buy them on the open market.
Which can be expensive and push the currency down itself, right?
Exactly. So this avoids that potential negative pressure. And the result of these combined efforts is pretty impressive.
That's a healthy buffer.
It is. It's a critical indicator of economic health and resilience. It signifies that the country has a robust buffer against external shocks and can comfortably finance its import needs for an extended period. This level of import cover is often seen as a benchmark for macroeconomic stability. It's a proactive step that leverages a national asset to secure currency stability.
Okay, so 4 pillars. The gold windfall, the IMF backing, aggressive rate hikes, and this gold bond initiative requiring CD purchases for gold. Quite a combination. So what does this all mean for you, our listener, whether you're observing Ghana from afar or perhaps considering engaging with its economy?
Well, it means a dramatically more stable economic environment. And this has direct, tangible impacts on everything from the cost of imported goods you might consume to how technology services are delivered within the country. When a currency strengthens like this, it makes the cost of doing business, particularly for sectors reliant on imports, significantly cheaper. And that, in turn, brings us directly to Ghana's bustling fintech sector, which is incredibly sensitive to these kinds of currency dynamics. Wendy, how is the Cedi's strength fundamentally reshaping that fintech landscape?
Okay, yeah, if we connect this to the bigger picture, the Cedi's strength isn't just about abstract macroeconomic stability. It's fundamentally rewriting the rules for Ghana's incredibly dynamic mobile money and foreign exchange fintech landscape. These are sectors that thrive on volume and efficiency, and currency stability changes their entire operating model. It forces a strategic recalibration that could actually make them even more resilient and innovative in the long run.
Interesting. So where do we start? Mobile money seems huge in Ghana.
Let's start right there with the mobile money sector. It is truly a cornerstone of Ghana's financial system. Our sources highlight that it serves over 50% of the population.
Over half the country.
Yes. And processing a staggering $150 billion in transactions in 2024 alone. That's a massive amount of economic activity flowing through these platforms. They're essential infrastructure for daily life and commerce there. So one of the immediate and most significant benefits of a stronger Cedi for these mobile money operators is reduced operational costs.
How so?
Well, think about it. These platforms, like, say, MTN Mobile Money or Vodafone Cash, they rely heavily on imported technology infrastructure, servers, payment processing systems, software licenses, network equipment. When the local currency appreciates, the cost of acquiring and maintaining this foreign-denominated technology immediately goes down.
Ah, right. The Cedi buys more dollars or euros to pay for that tech.
Precisely. And this isn't a small saving. It directly impacts their bottom line, freeing up capital that can then be reinvested or potentially passed on.
And crucially, these savings could translate into lower transaction fees for you, the user.
Yeah.
Right. When the cost for the operators decreases, they have more room to make their services more affordable, maybe even more competitive.
Exactly.
Which makes digital payments even more accessible, especially in underserved areas. And that brings us to another critical benefit: driving financial inclusion. With lower fees, it becomes economically viable for more people, particularly in rural areas, to adopt mobile money services. Ghana has this ambitious target, I think, of connecting 4 million citizens in rural areas by 2026.
That's right.
And reduced transaction costs are a huge enabler for reaching that goal, ensuring that digital financial services are not just for urban centers, but for everyone. Imagine a farmer in a remote village who now pays significantly less to receive payments for their harvest through mobile money. That small saving makes a big difference.
It really does. However, it's important to acknowledge that it's not all upside. There's a particular challenge when it comes to remittance inflows.
Ah, money sent from Ghanaians abroad.
Exactly. Remittances accounted for a substantial 3.2% of Ghana's GDP in 2024. A stronger Cedi presents a classic two-sided coin here. For diaspora senders, a strong Cedi means that for every dollar or euro they send, it converts into fewer Cedis for their families back home.
Right. Their money doesn't stretch as far locally.
Precisely. This effectively increases the relative cost for the sender and could, in turn, potentially reduce the volume of remittances flowing into the country.
That's a tricky side effect.
It is. So how do fintechs adapt to this shifting landscape? Well, mobile money platforms must become incredibly nimble and strategic. They need to explore strategies like offering exceptionally competitive exchange rates to attract senders, even if the overall Cedi value is high. But maybe more importantly, they need to offer more value-added services that go beyond simple cash transfers.
Like what?
Imagine services like micro savings accounts directly linked to mobile wallets, or perhaps even mobile insurance products that provide a safety net. By providing more comprehensive financial services and building deeper financial relationships, they can retain users and maintain relevance, even if the direct benefit from exchange rates diminishes. It's about deepening the relationship with the user base and becoming an indispensable part of their financial lives, not just a transaction facilitator.
Okay, so adapting beyond just the transfer itself. Now, let's pivot to foreign exchange. FX-based fintechs. Companies like Chipper Cash and Flutterwave, which facilitate cross-border payments and currency exchange. Their operations are inherently tied to currency movements, so the Cedi surge presents a very different set of dynamics for them compared to the mobile money guys. What does a more stable Cedi mean for their business model?
Indeed, John. For these platforms, the Cedi surge presents both significant opportunities and distinct challenges. On one hand, there's a clear opportunity for enhanced competitiveness. A stronger Cedi fundamentally lowers the cost of cross-border transactions for Ghanaian users. For example, if a Ghanaian business is importing goods or services priced in US dollars, the stronger Cedi means they need fewer Cedis to make that purchase.
Makes sense. Cheaper to buy foreign stuff.
Right. This makes it significantly cheaper for them to conduct international trade. This cost advantage encourages businesses to adopt fintech solutions for their international payments, maybe moving away from traditional banks which might have higher fees or less efficient processes.
So it pushes adoption of these fintech platforms.
Exactly. It's a clear incentive to digitize their cross-border transactions, leading to higher adoption rates for the fintechs. However, the flip side is a considerable challenge in terms of reduced profit margins. Many FX-based fintechs traditionally thrive on currency volatility and the arbitrage opportunities that arise from frequent, often unpredictable fluctuations in exchange rates.
Buying low, selling high, basically.
Essentially, yes. When a currency is stable and appreciating, those significant fluctuations become much rarer. This limits the opportunities for these platforms to make profits from those spreads, effectively squeezing their margins. Their core business model, which might have relied on capturing bits from that volatility, now faces a much calmer market.
So they need a new game plan.
They really do. It demands a new approach to revenue generation. So what's their adaptation strategy? It's all about strategic innovation and partnerships. Our sources mention Ghana's improved credit rating, with S&P Global's CCC Plus in May 2025. This is a crucial detail because an improved credit rating.
Even if still speculative grade, it's an improvement.
It's a significant improvement, signaling better creditworthiness. It makes Ghana a much more attractive and reliable partner for international businesses and investors. So FX fintechs can leverage this improved rating to attract international partnerships, maybe collaborating with global payment providers or established financial institutions. Instead of relying solely on volatility, they can shift to offering more sophisticated services.
Like what kind of services?
This includes providing hedging tools for businesses that need to mitigate currency risks. Imagine you're a Ghanaian exporter selling cocoa to Europe. With hedging tools, you can essentially lock in today's Cedi-euro exchange rate for your future earnings, protecting you from losing money if the Cedi strengthens further before you receive payment.
Providing certainty.
Exactly. They can also offer multi-currency wallets that allow users to hold and manage funds in various denominations, giving them flexibility and reducing their exposure to Cedi fluctuations when conducting international transactions. It's really a move from simple exchange to more comprehensive treasury management services for their users, providing more long-term value.
Here's where it gets really interesting for me. It feels like a complete shift in how these businesses operate. They're moving from, like you said, a ride-the-wave mentality, capitalizing on those rapid, unpredictable currency swings, to a build-for-stability approach, focusing on long-term value and efficiency.
That's a great way to put it.
It really forces them to rethink their entire business model from the ground up. And that stability is exactly what global investors are looking for when they consider where to place their capital. It's a sign of a market maturing, isn't it?
Absolutely. And this raises that important question. What does this Cedi rally and truly mean for Ghana's appeal on the global investment stage, particularly in the, ever-evolving tech space? It's not just about what Ghana is doing internally. It's about how the world perceives that, how it translates into tangible investment flows. The Cedi's rally has a direct and significant impact on enhancing Ghana's appeal to international investors. Our sources point out that the International Finance Corporation, the IFC, that's the World Bank's private sector arm alone, committed a substantial $422 million in fiscal year 24, specifically to fintech in Ghana.
Over $400 million. That's serious commitment.
It is. And that kind of investment flow isn't accidental. A stable and appreciating currency signals a dramatically reduced risk for investors. When a currency is volatile, investors face that constant threat that their returns, when converted back to their home currency, will be eroded. But with stability, especially appreciation, that risk diminishes significantly, making foreign direct investment, FDI, in promising sectors like digital payments, blockchain, and other emerging tech incredibly attractive. Investors can have greater confidence that their capital will maintain its value or even grow when repatriated.
So it takes a big risk off the table for them.
A very big one. And we can see this confidence reflected in the market itself. The Ghana Stock Exchange has shown strong performance, with increased market capitalization, specifically in the IT and finance sectors. This isn't just theory. It's tangible evidence that local and international investors are putting their money where the perceived stability is. And for direct investors, Cedi-denominated assets like government bonds become far more attractive. Not only do they offer potentially attractive yields, but the risk of currency depreciation eroding those yields is significantly reduced.
And that's supported by the IMF program and the reforms too, right?
Exactly. It's all further supported by Ghana's commitment to fiscal discipline and the ongoing reforms backed by the IMF program, which create a more predictable and investor-friendly environment. It's all about building trust in the economic management of the country.
So, for you, our listener, Whether you're a potential investor scanning the global landscape for opportunities, a business owner looking to expand, or simply curious about how these economic shifts play out in real-world scenarios, understanding these strategic moves is absolutely key. It's about recognizing where the next big opportunities are likely to emerge and how the foundational bedrock of a stable currency underpins that growth. But Wendy, while there's clear appeal, what does this new era of stability mean for how fintechs themselves need to operate? It's one thing to attract investment, another to strategically use it and, well, survive.
Indeed, and the Cedi's appreciation also necessitates a crucial recalibration of pricing and scaling strategies for fintechs. While lower import costs generally enable platforms to reduce service fees, which could boost user adoption and expand their reach, this simultaneously squeezes their profit margins.
Right, that balancing act again.
It's a delicate balancing act. How do you attract more users and grow your market share without eroding your own profitability? This demands efficiency and finding new revenue streams. So to scale effectively in this new environment, fintechs need to pivot their strategies. One key area is investing heavily in localized solutions. This isn't just about translating an app. It's about deeply understanding the unique needs, cultural nuances, and financial behaviors of the Ghanaian market and building products tailored specifically for them. And a massive opportunity here lies in integration with Ghana's centralized public sector payment platform, Ghana.gov.
Linking up with the government system.
Exactly. By aligning with this government-driven digitalization effort, fintechs can tap into a vast, officially sanctioned user base and ensure their services are part of the national digital infrastructure rather than just isolated offerings. This kind of integration streamlines processes, enhances credibility, and offers a clear pathway to mass adoption.
Smart move. What else?
Furthermore, consider the critical impact on exporters. We touched on this, but a stronger Cedi means that Ghanaian products sold internationally become relatively more expensive in foreign currency terms.
Making them less competitive, potentially.
Potentially, yes. This can put exporters at a disadvantage. Here, fintechs have a vital role to play. They must step up to offer sophisticated tools like those hedging mechanisms we discussed, allowing exporters to lock in exchange rates. They can also offer trade finance tools that provide working capital for international transactions, helping exporters bridge funding gaps and maintain their competitiveness, even with a stronger local currency. This shifts the focus for fintechs from, profiting on currency swings to actually facilitating and supporting vital international trade.
Becoming more of an enabler for other businesses.
Exactly. And finally, the appreciating Cedi significantly enhances the purchasing power of Ghanaian consumers. This might seem like a simple benefit, but it unlocks significant new consumer opportunities for fintechs. With more disposable income, or at least a stronger local currency allowing their existing income to go further, there's potentially a burgeoning demand for premium financial services.
Beyond just payments and transfers.
Right. This creates avenues for fintechs to innovate and introduce offerings like investment apps that allow individuals to easily invest in local or international markets, or perhaps digital lending solutions tailored specifically to micro, small, and medium-sized enterprises. MSMEs. These small businesses are the backbone of the Ghanaian economy, and providing them with accessible digital lending can fuel significant growth, empowering a new wave of economic activity and deepening financial inclusion beyond just basic payments.
That's a comprehensive look at Ghana's internal dynamics. Really fascinating stuff. But for our listener, who's always looking for the wider picture, how does Ghana's remarkable performance fit into the broader African and global market trends? Are other currencies showing similar resilience? Or is Ghana truly an outlier right now?
Yeah.
Wendy, let's maybe look at some key data points from our weekly Stay Wired recaps, FX Corner, and Market Movers to see how Ghana fits into that wider tapestry.
Great question, John. It's vital to place Ghana's story in context. So, in our current FX Corner, focusing on Africa as of June 19, 2025, we see that while the USD-GHS, the Ghanaian Cedi, did weaken slightly by 0.24% week to date.
Okay, we'll pull it back.
And experience a small month-to-date depreciation of 0.04%. This is an important nuance. We started this deep dive highlighting that 42% appreciation against the US dollar by late May. Market conditions are dynamic, right?
Always.
So, while there has been some recent softness in the Cedi, its year-to-date appreciation still remained incredibly strong at 29.93%.
Nearly 30% still. That's massive.
It is, and this resilience is largely due to those ongoing reforms and currency stabilization efforts under IMF guidance, which continue to provide a robust underlying trend despite minor weekly fluctuations. It's really a testament to the policies we've been discussing that even with these minor shifts, the overall trajectory remains so positive.
Okay, so a minor blip, but the overall story remains strong for the Cedi. How does that compare to what we're seeing elsewhere on the continent? Is this an isolated success or part of a larger trend of African currency stabilization?
Well, it's definitely a mix, which illustrates the diverse economic landscapes across Africa. Looking at other African currencies for context, the USD keys, the Kenyan shilling was basically flat across all periods. It ended the week unchanged at 129 per US dollar.
Very stable.
Exceptionally stable. No week-to-date or month-to-date movement, and a minimal year-to-date appreciation of just 0.20%. Different drivers there. Then the USD NGN, the Nigerian Naira, depreciated slightly by 0.42% week-to-date, reversing some of its earlier monthly gain. However, it still remained up 2.74% month-to-date, largely due to stronger oil flows and improved FX liquidity, a strong reminder of how commodity prices influence resource-rich economies. Year-to-date, it's marginally down by 0.41%.
Okay.
The USD ZAR, South African Rand, depreciated by 1.23% this week, showing a bit of weakness. It's now down 1.22% month-to-date, though it still holds a 3.69% appreciation year-to-date, supported by earlier gain and relatively stable fiscal positioning. And finally, the USD XOF, the West African CFA franc, which is pegged to the euro, actually appreciated by 0.44% week-to-date and 1.71% month-to-date. Its gain nearly 10%, 9.99% year-to-date against the dollar, supported significantly by the euro's strength and regional monetary stability.
So quite varied performance across the continent. Ghana's story, while remarkable for its specific drivers, definitely plays out within a region of different currency stories.
Absolutely, each with its own unique economic underpinnings.
That's a fantastic overview of the regional dynamics. Beyond currency, what other major headlines from our market movers this week, both globally and within Africa, might impact these trends or offer maybe parallel insights for Ghana's journey?
Sure. Well, our market movers highlight some ongoing factors. Globally, the Bank of Japan issued an inflation warning, leaving room for another potential rate hike later this year that just signals global central banks are still navigating these inflationary pressures. We also saw a warning from the Shell boss about a huge impact on trade if the Israel-Iran conflict were to escalate further. That's a critical geopolitical factor that markets always watch closely.
Especially for shipping and oil prices.
Exactly. Disruptions to major shipping routes can ripple across supply chains and commodity prices, which, as we know, are significant for Ghana. China, meanwhile, is actively talking up its digital yuan in a broader push for a multipolar currency system. That's a long-term strategic shift in global finance that all nations, including Ghana, will need to consider for their own digital currency strategies.
Interesting global backdrop. What about closer to home in Africa?
Okay, in Africa, South Africa's inflation held steady at 2.8%, which potentially opens the door for rate cuts there, a different policy direction compared to Ghana's aggressive hikes. Zimbabwe, meanwhile, continues to assert its gold-backed currency is stable, though investor doubts still seem to persist. That provides a fascinating contrast to Ghana's Gold Bond initiative. Proving stability through gold-backed policies is clearly a complex long-term endeavor. And we also noted that Nigeria is set to export its first gasoline cargo to Asia from the new Dangote refinery. That's a significant development for regional energy markets, which could influence trade balances and FX liquidity for Nigeria and its neighbors.
Fascinating how global events and regional developments constantly feed into these national stories. What about the commodities that kind of kicked off Ghana's remarkable recovery? Gold specifically. How are they faring now, and what does that mean for Ghana's continued trajectory?
Yeah, a vital question, especially given that gold windfall earlier. In our commodities corner, for oil, we observe renewed upward momentum this week amid those escalating geopolitical tensions, particularly following renewed conflict between Israel and Iran. At the start of the week, concerns about freight disruptions through the Strait of Hormuz triggered a sharp rally, with Brent crude rising over 10% initially.
Wow, big jump.
Huge jump. While it later stabilized lower as the prospect of immediate U.S. intervention remained uncertain, by Friday, Brent hovered near $76.96 per barrel, and WTI settled around $73.67. That marked a weekly gain of approximately 3.8% for Brent. despite a pullback on Friday prompted by the White House delaying any decision on possible U.S. intervention. The market remained buoyed by the potential for sustained Middle East disruptions. It just shows how sensitive these markets are to global events and how quickly the landscape can change.
Yeah, oil's always volatile. What about gold? It drove so much of the early CD strength.
Right. Well, for gold, often seen as a safe haven, we've actually seen a retreat this week, reversing an earlier rally. By the close, spot gold had declined about 2.5%, dropping to $3,333.99 per ounce, while U.S. futures lost around 1.4%, closing at approximately $3,361.80.
So gold went down. Why?
While this decline followed a substantial rebound in the U.S. dollar and strong Treasury yields, both of which eroded gold's appeal as investors sought returns elsewhere. On top of that, the Federal Reserve reaffirmed its stance against immediate rate cuts, further dampening momentum for non-yielding assets like gold. So while Middle East instability usually lifts gold prices, this week, that effect was insufficient to offset the stronger macroeconomic headwinds coming from the U.S.
Interesting. So it contrasts sharply with the earlier period we discussed, where gold's exceptional run was a key driver of Ghana's CD recovery.
Exactly. It just underscores the dynamic nature of markets and that even a strong initial catalyst can face counter pressures later on.
Okay. Finally, for those of you always looking for what's moving the needle, our recap includes a look at some of the most active stocks this week. These are the companies seeing significant trading volume and attention.
Right. And as always, a quick disclaimer, the information we're sharing is purely for informational purposes only and should absolutely not be considered financial advice. Market conditions can change rapidly, so always do your own research or consult a qualified financial advisor before making any investment decisions. Past performance isn't indicative of future results.
Got it. So what caught the eye this week?
Okay, that said, some of the most active stocks this week included NVIDIA Corporation, NVDA. Its last price was $135.13. It was down slightly by 2.92% this week, but still carries a strong buy average rating in the technology sector. Still very hot. Then we have Lucid Group, Inc., LCID, an EV company in consumer discretionary trading at $2.23, down 7.47% this week, holding a hold rating. Palantir Technologies, PLTR, also tech, was at $131.78, up just marginally by 0.0773% with a hold rating.
Okay, mix there.
Yeah. Ford Motor Company, F, consumer discretionary, at $10.38, basically flat, up 0.0157% and a hold. Tesla Inc., TSLA, another consumer discretionary giant, was at $346.46, down 3.34%, also rated hold. Apple Inc., APL tech powerhouse, at $207.22, up slightly, 0.0458% with a buy rating. And finally, D-Wave Quantum Inc., QBTS, another technology stock, closed at $13, up 0.0611%, holding a strong buy average rating. So that's just a snapshot of what was moving this week across tech and consumer sectors.
Great stuff. So if we wrap up this deep dive, it's really clear that Ghana's CD surge in 2025 is much more than just a currency headline. It feels like a pivotal moment. It's reshaping the economic landscape and creating a whole new set of opportunities and challenges for one of Africa's most vibrant digital economies. It really makes you wonder, doesn't it, how quickly a country's narrative can shift in global finance when fundamental policies align with, well, opportune external conditions.
Precisely, John. And to recap, the CD's remarkable appreciation has opened significant opportunities for Ghana's fintech sector. Mobile money platforms, for example, can leverage those reduced operational costs to potentially lower transaction fees, which is, as we said, a powerful driver for enhancing financial inclusion, especially in rural areas. However, for the foreign exchange-based fintechs, the lower volatility environment means they must innovate aggressively to maintain profitability, moving beyond simple arbitrage to offering more sophisticated services like hedging pools and comprehensive treasury management. This transformation isn't just about survival. It could ironically position Ghana's fintechs to become regional leaders in sophisticated financial services, setting a new standard beyond those high volatility arbitrage models common in other emerging markets.
A forced evolution, almost.
Kind of, yeah. And this newfound stability has undeniably bolstered international investor confidence. We're likely to see increased foreign direct investment in Ghana's digital payments and blockchain sectors, fueled by the country's improved fiscal health and credit rating. But sustained growth isn't guaranteed. It requires continuous vigilance in addressing underlying risks, such as potential commodity price fluctuations like we saw with gold this week, and the country's ongoing reliance on imports. These are the headwinds that policymakers and businesses will need to continuously navigate.
Constant balancing act.
It really is. Therefore, policymakers have a clear imperative. They must prioritize export diversification to reduce Ghana's dependence on single commodities like gold and maintain rigorous fiscal discipline to prevent future currency instability. Simultaneously, fintechs themselves must align their strategies with Ghana's broader digital agenda to effectively scale and contribute to the nation's economic progress. The outlook, as projected by the Ghana International Trade and Finance Conference, GITFIX, remains cautiously optimistic. They're projecting a 28.94% annual Cedi appreciation in 2025, provided these vital reforms continue.
That provided is key.
Absolutely. Ghana's fintech playbook is undeniably being rewritten, and those who adapt will truly shape its future.
Ghana's journey offers such a compelling case study in economic resilience and strategic adaptation. It's a powerful example of how a combination of strong internal policies and favorable external conditions can really turn the tide dramatically for an economy. Thank you for joining us on this deep dive into Ghana's economic transformation. We hope this has given you a shortcut to being well-informed and perhaps sparked your own curiosity to look a little deeper.
Yeah, and this raises an important question, maybe something to chew on. As global economies increasingly intertwine with digital financial systems, how might a country's success in managing its currency, like Ghana has demonstrated here, serve as a blueprint for wider economic integration and stability across entire regions? Could it perhaps even inspire similar deep dives in digital currency innovation beyond borders?
Absolutely fascinating to consider. Could Ghana be showing a path forward? That's a truly thought-provoking challenge for the future. Until next time, stay wired and stay curious.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.